Welcome back to my channel. This is RJ Trades, and if you have not, please don't forget to like and subscribe and comment. If you have any questions, please don't forget to comment too. Also, don't forget to click that bell button so that when I make other new videos, you will get notification and you can watch those. So today's topic is debit spread. So vertical debit spread. So it can be call or put. So a lot of people are still confused about what is vertical debit spreads, why they are in the money, why they are not making the max profit, and a lot of things like that. So we're gonna kind of deep dive into vertical debit spreads and kind of see what's going on. And also I'm gonna show you analysis tool, so you can see like you can simulate on what day if the price is something, how your what will be the value of the vertical debit spread. So let's get it started. So I have an Apple, for example. You could choose any ticker, but does not really matter. But this is just for demo. This is Apple. So what you are doing is you are long call. So you can choose your strategy. So we're gonna do long call vertical, right? Just go. Okay, so it's gonna pre-populate this. So vertical debit spread. So you buying two legs. Two legs means basically two option contract. Each one is called a leg. So there's few things, right? So first thing is you gotta select your expirations, right? Here in this case, it just auto selected 16 day. One thing a lot of people do is they select really early, like 1 week, 2 weeks. Again, 1 week, 2 week, if it goes in your direction, you can make profit really quick, but it's risky too. If you don't goes in your particular direction, you lose the value really quick too. So how theta works is theta accelerates as the expirations kind of expiration is the day when your option expire. So we're gonna talk about like a lot of people are still confused about assignment, exercise, and everything. So we will kind of deep dive. But see, this is option chain. Option chain has a lot of things like expirations, right? So September 11th, September 18th. So so if a vertical debit spread or even a call or puts or whatever is not in the money by that expirations, your option expire worthless. So that basically means like your option becomes zero. So this is expirations, there's value to it till this date. After that value, if it's not in the money, it's worthless, there's no value, right? So here let's kind of continue doing that. So this is September 25. Within that you have a lot of strike price, right? So a lot of strike price, you can see that 10 11 25 12 5 13 75 15 16 and all those, right? So you can select anything. One thing though, a lot of people, you're in a vertical debit spread, your buy leg strike should be lower than your sell leg. That's a must for a call, right? Your buy leg should be lower than the sell strike price. A lot of people, what they're doing is like they're selling this and buying this, and that's a opposite, that's a credit spread. In that case, you don't want it to reach there. Here in this case, you want it to go above and beyond. As it moves more, you make not more money, whatever you make, it's a constant. The max profit is always constant, but it's good if it goes up. So let's look at example here. So buy, so I'm gonna, for easiness, I'm gonna select something which is okay, that's 25, and let's select this 20, right? So this is a vertical debit spread where your buy leg you are buy to open BTO, buy to open this leg, and sell to open this leg. This is your opening up positions. You are buying, or you can open as a sell, but yeah, this is a opening up position, right? And there's a lot of things. So if you look at that, delta is 13, right? So you can actually see delta is 13. Basically that means delta is 13 means each dollar up. So Apple is right now 117. For each dollar up, you'll make about $13, right? So um so if it's 18.45 today, you'll make like $17. So whatever you cost plus that, your theta is negative 1.6. So each day it stays the same price, you will lose. This theta will increase as the expiration come. You still have like about 2 or 3 weeks here, so that's why it's low. But when you get like options which expire really next week or something, your theta will be really high. We can actually so expiration, right? If I decrease, see, there's, if I decrease 1 week, it's like that. If I decrease 2 week, it's 16 now. You see, that's theta gets really high if you are near in the money whereas like if you get like far out expiration, then theta goes not too bad. So okay, so this is October, we're gonna go September, same strike. So theta is pretty decent, right? And your delta is also decent. So theta is not, even if it holds, you're not gonna lose that much. If it goes a little bit, you make some money. Your max profit is 328. Max profit is width of the, so width basically means take a difference of the strike here, 5, right? 5 means 5 times 100, 500 minus whatever cost. In this case, it's, I'm gonna log this price. In this case, the price is 172, right? So 500 minus 172 is 328. That's your max profit. But a lot of people are confused why I'm not max profit. You will only get this max profit on the day of expiration. So basically you have to wait till when is this gonna expire? September 25. September 25. If it goes like 125 plus, you will make 328 in profit. So it has to be. So a lot of people's like, even if it goes 125 today, you will not make you will make probably $100 or something, but not, yeah, you'll probably make like 5 6 7, so 70, yeah, you'll make about $100 in profit, which is not bad. I mean, you can sell it right now. And the other questions I get a lot is should I hold or should I sell, or let it expire? I usually sell it well before expiration, and actually most of the people do that. The thing is, like, when you're profitable 20 30%, 40%, why are you holding it? A lot of people's like, hey, Apple is like 130, there's no way it's gonna go down, right? No, it can go down. If it can go up, it can go down. That's why your option, you are not getting full profit, because there are still chances like it will go down and you not make money, right? So that's how, like, a lot of people are asking, if you look at Tesla, right, it was 500 and a lot of people did not took a profit, and it went down like 350 or even $310, right? So if they had taken profit, they were profitable a lot, but they lost a lot. So don't wait till like till expiration, just take profit when you are happy, like 20 30%. If you have a lot of contracts, you can kind of sell some, write some, and you can do that. So yeah. And what's your max loss? Max loss in a debit spread is 172. Cause what happened is like, yeah, if it's below 120, basically your both leg expire, worthless, right? So both leg expire, so you don't need to do anything. So you just lost 172. That's it. You are done. If it's like 21 22, right, your buy leg is in the money, so you can exercise and get the difference. So basically if it's 22.5, you make 250, which is, you are still profitable because you paid 172. So 250 minus 170, so that's your profit. So up to this point, up to 122 124.99, basically other leg expire worthless, but you make whatever money. Lot of the brokers, what they do is, if there are chances like it both the legs will be in the money, they close out. Robinhood close out at like 3 p.m. like if it thinks it may get in the money, so there's risk of if it's one leg in the money, they just close it out. I think that's what they do. Even they will close it out, for example, if it's like 119.25, they have a formula where if it's risk in the money, they will just close out. This is just for your protections, and actually that's helpful in a lot of cases. Sometimes you may lose it, but yeah. So one thing though, if you let it expire, so it happened to me. So what happened was, so I have Tesla, I think I have a Tesla put, right? Tesla put. So put just opposite. So if it's uh, so Tesla put, and I was Tesla puts, you want in the money. So Tesla put, I think the price was price was 417 or 18. So there was, both the legs were not in the risk, but what happened was after 4 it dropped down to 390 or something, right? So what happened, the other guy exercised that sell leg, right? So when he exercised that sell leg, I was assigned 100 shares of Tesla at whatever price, which was 406 or something. So after 4, if it was 4, they will auto exercise, but after 4 you have to call them back, and they have a terrible customer service. So basically I was not able to call them back, and the other leg, my buy protection just just expired because I didn't do anything, so it just expired. So what happened was I got like those shares at 4 or something, and on Monday they just sold it like whatever the price, the market price, which is like 155. So I literally lost 500 I mean 5,000 in with the $18 debit spread. So it can happen. So that's one of the reason I would suggest, like, close it out early, close it out early, unless you are absolutely, and especially with the stock like Tesla, which can go so much down, because each dollar down is you are risking $100. So that can happen. So that's one of the risks, which doesn't happen often. It's probably like 1% or 2%, but that's their chances. So that's one thing. So other things I'm gonna talk about, pretty much that's about debit spread. And other questions I get it like, okay, so you have debit spread have a two legs, can you sell one leg? Yes, you can sell one leg, but it's not always advisable. For example, you have a buy leg and sell leg, right? So if you just close out, so sell leg, you sold it, so when you are closing out, you are buying back, you can do that. So if you buy it, you open, you only have one leg, which is buy call at 120. So that is basically buying one straight call, that's all it is, right? So if you have that, you can write it profit. For example, if it's going like 150, or before your profit was 5, here as the stock moves you make money. And the other things you can do it is, you bought this one, you can just sell this one, right? Then what happens, this become naked. So you sold call for 125, right? You sold call for 125. So anything above is your loss, right? So anything above, for example, in theoretically a stock can go like, I don't know, infinite number, right? So for example, you have Apple 125. If it goes Apple 225 the next, I mean, after you just have this leg, you can lose like almost 10,000, right? So $1 up, you lose like $100. So that can happen. So yeah, so not really advisable. If you want to sell it, maybe want to sell it this one like a sell leg, so you can let your buy leg only. I do sell sometimes, I have done, but that's about it. So I think, okay, yeah, you can see the probably of profit and everything's, and yeah, delta, theta, and max profit, it's pretty much shows up pretty much everything in this platform, which is pretty nice. And next we're gonna analyze, like, a lot of people's like, how do I see how much profit you'd make? So what you can do is, you can go to curve view and do analysis, and it will come up this, and theo spot price, you can just look at the price, and so it's kind of showing the price real time. So I locked at 172. If I bought it at 172, I'm at $8 loss right now since it's down. But here you can simulate what's gonna happen if it moves $1 up. Oh, sorry, that was profit. Okay, okay, this is profit tier. So right, so right now you're at 137 profit at this price if you bought it, but if it go $1 up, you made $13. See delta, it just adds delta, that's all. So 18, you make 26. If it goes 20, you make 39. So let's say if it reaches 25, you just make $100. You cannot get, you not gonna get 328. That's what you get. Similarly, for example, if it's 28, right, each day passing you make money, in the sense you are in the money and there's less time to go back to the previous price. So 909, see, next day you make $2, $5, 13, 15, 18, you see, 20. So you can simulate and play around and see it. So to make max profit, it has to be expiration, right? So which is 928. So see, 928, that's your max profit, you make that much, right, if the price is that. So yeah, you can kind of simulate and see. It says expired because I went beyond that, but it does tell you, you can actually see and simulate and see. That's pretty cool. So yeah, I think I pretty much explained everything about debit spread. So that's all. One thing why you buy debit spread is basically, one thing is cheaper, right? So we can kind of go over that too. So if you go to leg, and so if I delete this leg, if I just buy 120 call, it's gonna cost 460. not a lot, but it's still expensive, right? Before it was like almost half the price. With Tesla it can be really really expensive. With Tesla it can go like 2000 or 3000. So it's like a one way of buying cheap option. Your reward is limited, but your risk is also, you are risking less money. Here you are risking 460. If it doesn't reach 120 by expiration, you make nothing, so you lose everything, right? But on the other side, if it goes 150, you make what? So $30, so 3000 minus 460, so you make almost 2600, right? So there's a good like upside too. So if you are really bullish and you are day trading, probably you should not even do spreads. Spread is in the, cause you wanna get in, get out, right? With the spreads, your money growth is really like really slow. For example, if you're gonna go analysis right here, and curve, and yeah, here, right? Each dollar up like so each dollar up, see 89. So your growth is really quick here. Before it was really slow. It's same day, you don't even need to worry about. So if it goes 125, you just made 500. Same thing, right? You paid 400, but it's almost 504 worth. So your rate of increase is really high with the straight call. With the spread, it's slow. Yeah, I mean, pretty much that's about it. If you have any more questions or comments, do let me do comment below. But that's about it. Thank you everyone, and yeah, don't forget to like and subscribe. Thanks.